Hi everyone, I hope all of you are doing well. Today I and Shantanu are going to give a presentation on Punjab Chemical and Crop Protection Limited. India's chemical sector is expected to do well in the future mainly because of the China Plus One model. China Plus One model came into existence during the presidency of President Trump. It further accelerated due to the COVID-19 pandemic. And now, due to the Russia Ukraine war, a new trend is starting to develop where companies are trying to shift production out of Europe because of rising energy prices. German giant BASF has said it is thinking to shift to Asia for production of its chemical, mainly because of rising fuel price. This favorable tailwind can give investors multi-bagger return, as currently India accounts for only 5% of world's chemical production. So in this presentation, we will try to find will Punjab Chemical be able to get the benefit of such strong tailwinds blowing? Uh, Now, the company which we know today as Punjab Chemical was incorporated in the year 1975 as Punjab Union Pesticide Limited. It was a joint venture between Punjab State Industrial Development Corporation Limited and Excel Industries, with both having 25% of the stake, and the remaining 50% stake was held by the public. The company started its initial journey with the production of general basic chemicals like oxalic acid, which is used for removing rust and stains on metal, and dimethyl oxalate, which is used as a raw material for making etching agents for electronic materials, mainly to cater to the domestic needs of the country. The company diversified into the specialty chemical in the year 1983. PSIDC disinvested its stake in favor of the nominee Excel Industry in 1985. The next major change happened in the company when it entered into when it entered into agrochemical when it entered into specialty chemical in the year 1983. The Punjab Chemical entered into agrochemical in the year 1995. Then Punjab Chemical decided to enter the pharma sector by acquiring Alpha Drug India Limited. All group companies uh, were put under the same umbrella in 2006 as Punjab Chemical and Corporation Limited. The company's operation was seriously affected due to a fire in one of its major agrochemical manufacturing plant in the year 2009. Company, because of this, was passing through a severe liquidity crunch, but this was even worsened during the 2012 European financial crisis. Due to this crisis, many of the company's clients in Europe delayed their payment. This led the company to default on its loan, and as a result, the company had to undertake a corporate restructuring scheme. Under this scheme, the promoter, Shalil Shroff, who is now the current MD, decided to infuse 20 crore of share equity uh, at a price of 100 crore to the company. Even after that, the company was unable to raise fund from India or international market. And as a result, the promoter family decided to infuse another 30 crore to the company as a debt. The CDR plan allowed the company to defer its interest payment for nearly 2 years. And as per the CDR scheme, the company was required to dispose of its various non-core assets and uh, companies' operation which are not profitable. For example, the company sold its agro formulation division because it required high working capital and it had very low margin. The company also sold its Tarapur Industrial Chemical Division to UPL. The company is also sold it had various office building in Bombay, which it also sold to the UPL. The OTS, the one-time settlement proposal with RBI was accepted. As per the terms of OTS, the company paid 45 crore and sale proceed of 1 lakh share of company pledged with SBI against outstanding due of 94 crore. Company's fortune started to change when it entered into CRAMS, or to be more precise, the company started giving more importance to CRAMS. The company also sold its two loss-making subsidiaries located in Argentina and United Kingdom. At present, the company has only one subsidiary, which is wholly owned. From 2018, the company is mainly focusing on the CRAM segment. Now, we will discuss about the products of the company. Now, the company deals in both generic and patented. Although I will say the company's portion of generic product is more than its portion of patented product. The company produces this four main molecules: metamitron, metaconazole, diflucane, and chemical X. What is chemical X? I will explain you later. And apart from this, these are basically the main molecules. And apart from them, the company makes dozens and dozens of other generic products. Now, I will start with metamitron. Now, metamitron is mainly used as a pre-emergent and post-emergent weeds, especially in case of sugar and wheat crop. That is, these are spread in the field before and after the crops are harvested. It was first developed by Bayer, the German giant, in 1975, and as you can understand that the patent has already expired. Punjab Chemical mainly supplies metamitron to UPL and ADMA, who are the significant players in European market. In India, only Punjab Chemical has approval of metamitron, and the company supplies 70% of the demand. Himani Group and Best Crop has applied for an application of metamitron, but they have not been able to crack it. Like Himani Group had applied for it, it has been 6-7 years. They have not been able to get registration for metamitron. Now I will talk about metaconazole. Now, metaconazole was discovered by Korea, and it was initially developed with bats to control a range of fungal infection in certain crops. In 2003, Relish tied up with Korea for 100% oriented project of metaconazole. Uh, Relish still today makes metaconazole. Magma has applied for environment clearance for a capacity of 2,400 megaton, which is the 10 times capacity of Punjab Chemical. So Aztec, Anupam Rasayan, and unlisted UMA Organics have also applied for metaconazole capacity. So you can see that there is a lot of competition is coming. The company is going to face in case of this molecule. Now I will move to diflunisine. Now this molecule was created by Bayer. It aims to tackle most water hump and plumber weeds. The main market of the company for this molecule is in Latin America. Punjab is the only other company apart from Bayer and certain players, a Chinese player, to make this product. However, during last few years, the company had to reduce its price. No, sir, we are not able to get the percentage of revenue per molecule. We are not able to find that one. And uh, the company was forced to reduce its price because it was engaged in a price war with its Chinese competitor. But finally, it was able to win that competition, and now it has 50% market share in the Latin market. And the company has also no dependence on China, as they are backwardly integrated regarding this only regarding this molecule. The company has dependence on China related to other raw materials, but not that one. Now I will move to chemical X. Now the company first mentioned about this molecule during the financial year 21 con call. The company does not want to tell us who are its clients, or what is the function of this molecule, but the company has said that this chemical has a market share of 1,000 crore and only Punjab makes it. Now 1,000 crore is the revenue of Punjab for the last year was 1,000 crore. So you can see that a single molecule has the power to double its top line. So I assume because the secrecy they are maintaining, it is a patented molecule. And now I will move to some honorable mentions, like the oxalic acid and diethyl acid oxide. These were the first two molecules which Punjab Chemicals started to produce. I wanted to say about these molecules because uh, now you will be able to realize that how far the company has moved on. These two chemicals now only contribute 10 to 20 crore of Punjab's top line, whereas Punjab's top line is around 1000 crore. Phosphorus-based products are mainly used in soft drinks like Pepsi and Coca-Cola are their client, and Lancil, Sanzyme, and ethoflutamide are herbicides. These are not patented. They are quite generic product. And apart from this, the company makes a plethora of generic products. Now I will move to the clientele of the company. Now, don't get enamored looking at all those big clients. Although these are huge names like Bayer, UPL, Ardma, Coca-Cola, Pepsi, Korea, but the company has mentioned even in its con call that he is not the only supplier of any of those company. Their vendors maintain 3 to 4 uh, other vendors. So it is not that um, Punjab Chemical has a monopoly in this case. It has also to deal with a lot of competition. Uh, Now I will move to the next point. Now, I will talk about management integrity and risks. Now, in order to determine whether the management is honest and what is the level of transparency, I will try to answer a number of questions. And by answering all those questions, we will get a little bit of idea how the management is it shareholder friendly or not. Now, our first question is regarding dividend. Has the company given dividend or has to a shareholder? Now, as I have earlier mentioned, the company was in very dire stage during the 2010-12 era. Not only be, not only because of the fire, but also due fire in its plant, but also due to the European crisis. The company was in a position of like going to bankruptcy. So at that time, you can see the cash bank had very minimal cash, and its net cash flow was also negative for most part of the from 2014 to 2018. But now recently the company is generating a little bit of net cash flow. It is earning a profit, and the company has started to pay dividend. Although the dividend is not that high, but even if the company is paying dividend in just after recovering, we can see that the company thinks about the shareholder. It is paying dividend. It is also carrying out capex. So we can say the management has done whatever it could have done in its capacity. And now, if the PAT keep on increasing, their margins remain the same or increase, we would like to have a higher dividend payout. Now I will ask: is the management transparent or not? Now, I consider the management of this company mainly because of three main reasons. The management gives the name of the chemical it produces. In it, if you visit its website, you go to the product subsection, you will find all the chemicals it talk about, like the metaconazole, metamitron, and all the generic. They are very openly talking about it. They are not hiding anything from us. Then the company also talks about its pipeline, product pipeline, product pipeline. Although I what I have noticed that its product life pipeline is not that big. It has only 10-12 products, but it can be considered as a negative fact, but still the company is displaying it. So I am very much impressed with it. And the last is that the management explicitly mentions about various risks and mitigation strategy. Like I have read, I will not say quite a lot, but the annual reports which I have read, most often I have seen the companies are very neglect in highlighting the risks of the company. What they mainly do, they just talk about that the company has a risk community and the independent director is their member. They don't talk about any much risks or something like that. But this company has talk about risks in a very very good manner. So I am very much impressed with this, and all this has uh, um, allowed me to conclude that the management is transparent. Now, let us move to the next question, and it is regarding the succession plan. Now, yes, you can say that the company is promoter driven because the promoter owns 45% stake in the company. But as you can see, they don't hold the majority with them, and the public has more than the majority. And the most disturbing part about their is their succession plan. The company son or company's his daughter, they are not in the business. We don't know who is going to lead him. There is no family member in the board. So, and the company has also not mentioned anything about the succession plan. So I can say there is a lot of ambiguity regarding who will succeed him. So yes, it's true, the succession plan is not clear. It can be a negative point. Now let's move to the next point. Now, we have carried out the forensic analysis of this company, and this company, I will say, has done not bad, but it would have been better if it could have done better. Now, these are the various six problems which we found. The first problem was, as I earlier mentioned, the company promoter doesn't have 50% promoter holding. His promoter holding is a little less than 40%. Now, regarding board quality, there is one board member, Captain Surjit Singh Chopra. He is an air officer pilot. Now, there is a father-in-law and son-in-law relationship between the current MD, Salil Shroff, and this gentleman. So, uh, I don't think it is much more, it has any relevance in a chemical factory, but it is not that a large red flag. But still, I would have offered in anyone professional. And now, related to related party transaction, this is quite a shocking revival. Like the company had paid 2.2 crore land to the promoter family. So as you know, the company was in very dire state, and still today the company has a profit of something like 60 crore or something. It is not a huge profit. So if in this they take 2.2 crore, I will say I would have I don't like it. And similarly, for the case, the sale of good amounting to 1.65 crore to enterprise, where the control composition was related to the promoter favoring. This is another red flag. And the most staring red flag which I found out was that I said no during the earlier presentation that the company was not able to get much any money. Apart from infusing capital, the promoter had also given loan to the company. So company paid 12 crores to Hanshield Trading and Manufacturing Private Limited, which is the promoter of family company. So I tried to search regarding that, and I find out that the company paid something around 15 to 12% interest on that loan. So I found it very disappointing regarding that. And another minuscule thing is that they are other expense compared to their revenue was 15%, 15.8%. It was slightly higher than we expect that it should be lower than 15%, but that's okay. But the most important thing which strike me was the point 3 and point 5. Now, I think Shantanu will present. Oh, sorry, I have one left. Sorry. Now, I go to the peer comparison. Now, first, I'm going to compare what is his name? Punjab Chemical with Bharat Rasayan, Heranba, Relis, and Dhanuka. Now, in terms of revenue, Heranba has grown the fastest with 740 crore revenue in FY18 to 1450 crore in FY22, which is a 24% CAGR. Heranba was followed by by Dhanuka, Bharat Rasayan, Punjab, and Lalis. Punjab has grown its sale by a decent 15%. I know I have not shown the number because if I had shown the number, it would have become so clumsy. So sorry for that. Uh, Now I am going to move to the gross margin part. Now, thanks to the cramps which the company started focusing from 2016, the company has improved its gross margin drastically, whereas Dhanuka and Reli's gross margin have fallen. Bharat Rasayan has been able to increase its gross margin, but not like Punjab. Now, I will move to the PAT margin, which is more important. However, if we see in case of PAT margin, Punjab has not been able to keep similar performance. In case of PAT margin, Punjab PAT is lower than Bharat Rasayan, Haranba, and Dhanuka. Now, I will move to the debt path. As you can see that over the year, every company in this comparison have lowered its debt. Although with the exception of Dhanuka, because Dhanuka had very less debt. Now you can see in 2022 it has negligible. It had 0.03% debt. Now, Punjab has reduced its debt quite a lot. Once upon a time during the 2018, nearly 100% of its capital was made out of debt, and now it is reduced to 30%. It is good, but I will expect it to improve further. Now I will move to the NFAT, that is net fixed asset turnover ratio. Now, Punjab improved its NFAT from 3.5 in 2018 to 4.2 in 2022. That is an increase of 20%. Bharat Rasayan improved its NFAT by 6%, whereas Haranba and Dhanuka NFAT fall by 55% and 38% respectively. Rallies maintained the same NFAT. Now I will move to the next point, which is relating to the working capital. Now, as you can see, Punjab is perhaps it is the only company which has been able to maintain very good working capital requirement. The whereas for in case of Haranba, it has skyrocketed, and Bharat Rasayan's working capital has also increased. Dhanuka has been able to decrease its working capital requirement, but still it is quite a lot. Now I will compare the cash flow of the company to EBITDA. That is whether the company is able to convert its cash flow to EBITDA. Now, Punjab Chemical performed very well in 2018 to 2019. As you can say, that this entire cash flow is translating its EBITDA. But starting from 2020, it was not able to convert even half of its cash flow into EBITDA. Now, similarly, it was the case for 2021 and 2022. It is a slight improve. So I hope that they are able to match the levels of um, Lalis. And although, but if you can see broadly, other companies have done well, but but Punjab Chemical is not that far behind. So I think they will able to catch up. Now, let us move to the next point. Now, here I am going to compare the company's sales and its marketing expenses. Shantanu, please give both of them, both the slide together. Yeah, thank you. Now, if you look there, um, Punjab Chemical, Bharat Rasayan, and Haranba, they spend very less on their marketing and sales, both in terms of absolute amount and also in terms of percentage of their revenue, because this company mainly deals with are in B2B segment, and whereas Dhanuka and Relis deal mostly with not entirely, but they deal a lot with the farmers, so they need to incur a lot of expenditure on sales and marketing. So this is the reason where you can see that Relis and Dhanuka are outstripping Punjab, Bharat Rasa, and Handrava by a large extent. But otherwise, you can say it is quite comfortable. It is in 1 to 3 range, and they don't need to spend so much on sales and marketing. Now, I will give to Shantanu. He will continue the presentation. Over to you, Shantanu.
Thank you, Rishabh. So I'll begin with the business value generation. So if we look at the top line and bottom line growth, over the last year, last 10 years, we can see significantly from the last, say, 6 years, that's from FY18, we can see that both the top line and the bottom line has been growing. However, past that, we know the situation. They started trams in FY16. As of FY17, their expenses were higher, and this resulted in lower operating profit compared to the previous years. That is how their PAT was basically suppressed during FY17. And after that, they have been able to ramp up their revenue and PAT numbers. If we talk about their ROE and ROCE, as of 2014 and 2015, their equity was in negative thanks to the debt acquisitions that they had done back in 2008, etc. They had a lot of debt, and their FL ratio as well was uh, a negative figure. So their debt was basically outweighing their assets, and because of this, their PAT itself stood at minus a negative 3.8%, which resulted also in a lower return on assets. There, that's why we kind of see a weird um, decline in FY15, FY17. And after that, since they started CRAMS in FY16, we can see from FY18 to FY23, they have a pretty normal linear graph. They've been able to ramp up the numbers. And yeah, definitely before that, negative profitability was affecting their net profit margin and the DuPont ROE formula as well. Next, we move on to capital allocation and acquisition. So, firstly, like, um, like Rishabh already mentioned, that they went on a debt-funded acquisition spree in 2008, which was very badly timed. They wanted to move up the value chain by buying out global AgChem companies as the subsidiaries, and the ones which had registrations in developed countries, basically. But the timing of this was absolutely horrible because, firstly, though their acquisitions were funded through debt, that led to the company basically defaulting on their debt obligations when they couldn't even raise equity from the market after obviously the 2008 market crisis. And in addition to this, they also suffered losses in derivative contracts as well, obviously. So, and then uh, like one more thing which was very unfortunate for them, it was like a series of things. So in 2009, there was fire in one of their factory units, which is very unfortunate again for them because they were already in enough debt and were suffering enough. So they basically went through a big turnaround phase after these events, and they were only focusing on improving profitability and reducing their debt basically. So what did this do for them? Just like how did this affect them? First, though, their export revenue was strained. Then the losses were directly shown in their profit and loss account and their balance sheet as well. Then they had difficulties raising equity as well. Then loan repayment was a big problem for them because all these acquisitions that they were doing were debt funded. Then plant performance as well. There was fire, then there was shortage of working capital. This also declined their overall performance as a company. And lastly, the subsidiaries that they had acquired in the international companies, their net worth as well, like faced losses from the sale. And then later on, we saw that they sold most of these subsidiaries, and now they only have one subsidiary that does marketing for them. And yeah, next point. So they now they have planned since FY21. They have planned a capex of 150 crore over the next 2 3 years until FY24, and the asset turns that they expect will give them 3 to 4x returns from this investment, and the net asset block will generate 200 to 300 crores in the next 2 3 years that are coming. So what they are planning to do in this is basically one, firstly is the new building, as in they have recently completed construction of a new building and it will be operational for installation of plant and machinery. And then next is their Latin America market. So primary purpose of this new building that they have constructed is to cater to the Latin America market, specifically for a herbicide. So they have basically increased the capacity of producing this herbicide, manufacturing this herbicide. So another thing is their land bank. They possess a large land bank of around 49 acres. This provides them flexibility for a brownfield expansion in the future. So one facility is Lalru facility that basically manufactures specialty chemicals. So it spans over 25 acres and is currently only occupying 11 out of the 25 acres. So there's spare land which is available for potential expansion. And this is part of their plan. So actually large part of their CRAMS business comes from this facility, that is the Lalru facility. Then there's one more plant. It's the Derabasi plant. This one manufactures agrochemicals. So these are all like their generic mature products, and what they're doing here is basically debottlenecking and capacity addition through debottlenecking. So 2,000 tons is what they are aiming for, and for Lalru it's 1,000 tons. Their payback period is approximately 2 years. So they're expanding their Pune facility. Pune facility is the one who's doing industrial chemicals for Coca-Cola, Pepsi, etc. So yeah, this is definitely they don't contribute. This facility does not contribute so much to their revenue. It's only 15-20 crores. But however, they're planning to expand this facility as well by like acquiring the adjoining plot, and because they see a rise in demand for industrial chemicals like phosphoric acid and yeah, they already produce for large MNCs like Coca-Cola and Pepsi. So what they want to do is basically expand and kind of double their revenue from this source. Lastly, they are commercializing new products. So they actually list down the product pipeline every quarter in their investor presentation, which the latest one I'll share in the coming slides. But yeah, with Nippon, they have commercialized one new product recently, which is under stabilization. So each of these would be contributing 15 crores, and their aim is basically to generate a revenue of 1,500 crores. Currently, they're at 1,000 crores. So 1,500 crores, and this is their plan basically to reach that. Next, if we go to capex cycle and plant capacity utilization. So from 2020, they had, like I said, they had planned a capex of 150 crores. So they've been adding capacity and doing major capex. And yeah, remaining there's around 120 crores yet that they have to still spend. So major investment was like made in increasing capacities basically. So if we talk about the results of this, they are combined like of the all three facilities, their capacity utilization is currently at 85%. They also saw volume-led growth. They are seeing as of FY 2022, they mentioned that they're seeing demand growth of 40 to 50% for some products, and they are, in fact, also they've been able to maintain it above 4x. Currently, it's at 4.2x for FY23. So yeah, so that herbicide that I mentioned, they increased the capacity of manufacturing it from 300 tons per year to 800 tons, because this is directly going to Latin America, that is Argentina, where they have a 55 to 60% market share. Then, so they want to double the production of this product basically. Then Derabasi, like I said, 2,000 tons they aim to increase the capacity to, and Lalru, they are adding a new intermediate as well, which will be included in 1,000-ton capacity. And other than that, if we talk specifically of each plant, then the Derabasi plant is at a capacity utilization of 80% above. However, the Lalru plant is at 60% because they have had some challenges while operating there, but they are adding these intermediates to kind of improve the capacity utilization. So yeah, they are adding new products and utilizing both all three of their facilities. And also they are exploring new market of registration for Nippon, that they have commercialized two new products, like I said. So they are kind of trying to generate more revenue from the Japanese, and this like expect to start rolling out these products as of FY24. Next, we move on to capital prudence. Sorry, my bad. Yeah, so I basically wanted to show the NFAT. So, like I said, they've been able to maintain it above 4x since FY22. And over the years, if we see, they have been sustainably increasing the NFAT ratio. Just to reassure that they've been like doing heavy capex from the 150 crores that has been planned out. We can see since FY 2020, they have been spending almost double of what they had been spending earlier. This is because they want to expand into CRAMS and explore new markets and improve their capacity utilization. Lastly, yeah, again, this is just to measure the acquisition of property and other investments, etc. So here as well, we see the same picture that they have been spending more money, and that eventually we'll see how it pans out for them. How they if they are able to generate the 200, 300 crore extra revenue that they are talking about. Capital prudence, if you see in every investor presentation, they mention this that clients fund a proportion of capex to expand production, and this helps them smoothen their export revenues as well. So, like in 2016, to get out of the financial mess they were in, they opted for CRAMS for like MNCs, etc. So their first contract was with Pureha, which is a Japanese company. And currently they work with, we've seen the slide on the key clientele, so like Corteva, UPL, Adama, etc., etc. And so this is structured through like long-term contracts of like 5 years. And the advantage that I find here for them is that their customers part finance their entire capex requirement, that is 50%. And this is mostly for registration of these molecules in the other countries. So funding structure, like I said, 50% of the capital expenditures are funded by the customer. So the company is receiving financial support from its customers for a significant portion of their investments. Remaining of it is funded by the company itself through like a combination of internal accruals and debt financing. However, the majority is internal accruals because I think they kind of have refrained from relying on debt after what had happened with them, and they kind of avoid taking more and more debt. That's exactly why I think they have this model in the first place. So another thing they're doing is asset renewal. That is, they have 30, 40-year-old assets that they have been renewing using this capex amount. That so they want to upgrade their infrastructure and equipment to like achieve an optimal operational efficiency. So this also kind of helps them save cost because they're renewing their same old assets, and also they, according to them, this will also help them become a little more energy efficient because their energy costs are pretty high. And lastly, one more thing that I noted was their maintenance capex. It's mostly done through internal accruals itself. So this also is a good advantage for them. Next, we'll look at few metrics with respect to capital prudence itself. So if you look at their CFO, it's I mean they've been able to generate significant cash flow, I'd say, from their operating activities. But at the same time, they've been putting back a lot of money in as well, and they're comparatively smaller as when we compare them to these other peers, say that is Bharat Rasayan, Iranba, Rallis. So they are comparatively smaller. That's and then if you move to their FCF, free cash flow, so we can see that how much amount is left over after their capex and necessary expenses. It's not a lot, but yeah. Next, D ratio. This kind of gives a picture of how their turnaround worked out. From 2008, they were in a bad debt. They were not able to raise equity. The equity was in negative, in fact. So if we see, they have been after FY16, their focus, which has claimed by them of reducing debt, they have been pretty successful at it. And as of FY23, their D ratio is very low, I'd say, at point sitting at 0.33. So yeah, next we move on to ICR just to see it along with the D ratio. It's greater than 4 as of now, sitting at 6.8. It's slightly volatile, but yeah, they have enough. They have the ability to meet their interest obligations. I'd say they are in a good position to service their debt. Next, yeah, I'd like to talk about their business model. Here, I'd be repeating a few things, so it'll be like a summary of whatever Rishabh has already said. But yeah, I'd like to kind of formulate their model through it. So they are again, we know they're in the business of manufacturing performance chemicals, technical grade chemicals, agrochemicals, specialty chemicals. They're doing CRAMs. So they are also in the overseas market, and they have an arrangement with and big like a lot of MNCs. So their subsidiary, they have one subsidiary. They sold the other ones because they were loss-making subsidiaries. So they have one subsidiary in Belgium, Europe, which is a marketing company. So they have various marketing registrations, and yeah, so they help supply companies products from Europe. They then already we've talked about their three facilities: Derabasi, then Lalru, and Pune. So that Pune one is the one which is serving to Coca-Cola, United Breweries, PepsiCo, etc. Business units, if we talk about, then yeah. So they have four business units. That is agrochemicals, pharmaceuticals, intermediates, industrial and specialty chemicals, and international trading, of course. So agrochemicals contribute around 80% to their revenues, and pharma and fine chemicals is less than 10%. So out of the total agrochemical share, around 60-70% comes from CRAMS itself. So with the kind of demand that they have been able to generate in the last, say, 5 years, their contribution has grown by 3 to 4 times over the years. So they also manufacture intermediates for agriculture or chemical and pharmaceutical industries. And even though it's a small like business with I think around 15 crores revenue for them, but they still look forward to diversify in this field, and they want to advance. Furthermore, they yeah, like I said, they about phosphoric acid. They have been trying to get the expand into the adjacent plot in the Pune facility, and they have recognized demand from industrial MNCs, and yeah, currently it contributes around 15-20 crores, but they want to double it, and eventually are looking at 50 crores from this business itself. Next, yeah, like I said, they list out their product pipeline every quarter in their investor presentation. So you can see the kind of molecules that are in their product pipeline. If we talk about, so they have like it's a pretty robust pipeline for like new products, and like they expect to propel their growth through launching these products, and they expect around 70 to 80% turnover from these products. So they want to diversify and expand into new geographies. One is, so they've already expanded into Latin America, where they want to expand further. They want to expand into Australia as well, and they also want to improve their domestic foothold, as many like we had seen in one of our earlier sessions that India imports around 50% of chemicals. So this import substitution, yeah, they plan to take advantage of that as well. And then they also want to develop molecules which can offer them a revenue visibility at least for 15-20 years. And their potential targeted revenue, like I said, it stands at 1,500 crores. However, they have not given any particular timeline for this, but yeah, they aim to achieve 1,500 crores of revenue. Next, we move on to their growth triggers. So, firstly, I'll talk about export-oriented growth. So, 54% as of FY 2022. 54% of their revenue contribution is from exports itself. And year on year, they've been able to grow the percentage and decrease the percentage of the domestic revenues. So Europe is a major market for Punjab Chemicals, and more than 30% of revenues of the total export revenue was contributed from Europe, and then followed by Japan at like around 17%. So they are looking to like penetrate and grow in the international as well as domestic market, and they want to, again, like I said, improve their positioning in Argentina and Australia with new contracts and products. That is Nippon, which they're trying to get registrations for. And then there's already ongoing contracts, as in they have contracts with ongoing contracts with 6 customers. They have signed 2 more contracts, and 3 are under negotiation. So they have signed a long-term contract as of FY 22 with Nippon on exclusive buyback basis. Capex, we've already talked about it, so I wouldn't go into detail. Like I said, 150 crores of Capex, and then the land bank and how they plan to expand and which markets they plan to tap into, and then brownfield expansion as well. So this is something that could be a potential growth trigger for them. And growing clientele, yeah. So it's a major CRAMS player, Punjab Chemicals, and they have been able to get global players, on board, which essentially like includes Japanese, European players, and so it's difficult to maintain a client relationship with, especially the Japanese, because they're very particular about their due diligence. So yeah, this is something that they have been successful in. And Adama, I think they have been a client since the last, I think 8 years. I'm not too sure. I'll have to confirm. But yeah, they contribute around 20-25% to the revenues of the company. And UPL itself contributes around 35%. And then the other companies from Japan, which contribute around 30%. So they using this clientele of theirs, they expect to grow more, 20-30% more. Lastly, sorry, not lastly, margin and return metrics. If we compare the cost of equity and the return on equity, we have calculated for the cost of equity for 3 scenarios here. In the first case, we have taken the 10-year CAGR of Sensex. Second one, we have taken the 5-year CAGR of Sensex. And third, we have taken the average of the last 10 years and last 5 years. So ever since FY16, if we see, since they got into CRAMS, they have been delivering a good ROE to its shareholders. But at the same time, it's also somewhat volatile, even though I could say that after FY16, they've been somewhat constant. At least they've been above all the 3 cases of cost of equity, but it's slightly unpredictable because uh, I mean, their future growth, as we can't really predict because there's not a lot of information as such. Next, okay, let's talk about their gross margins. So here, there's not much I'd like to mention, but one thing that I noticed while reading their con calls and annual reports or their investor presentations, every time their gross margins have kind of been suppressed, they mention that it's mainly due to the raw material price risk that they face, and this is why sometimes their gross margin as well as their EBITDA margins kind of get suppressed. And GM to EBITDA conversion, again, it's volatile, but it's linearly increasing, I'd say. So here also, again, EBITDA margins, they keep mentioning that their raw material price risk is one of the main risks that they face. And that is exactly why I'd like to talk about their material cost next. So if we see, their raw material cost has been constantly increasing since FY14. So they are dependent on some international players for their key input and raw materials, and non-availability of these materials can directly affect their production. This like translates into their margins, and then we see the compression there. So I'll name a few raw materials. So hydrogen hydrate, then aluminum chloride, anhydrous, ethyl acetate, etc. There are many, but however, that's not really important to us right now. So So if we talk about their raw material imports, as of FY 2021, 35% of their raw material is imported, and they get into long-term contracts with suppliers for key materials. That is, like Rishabh mentioned, there are two most key chemicals, that is metametron and hydrazine hydrate. They are imported from Europe, China and Japan. And out of this total 30-35%, 30% share is of China. So they are very much dependent on China for these materials. So metametron and hydrazine hydrate are again very important to them, and they are now entering into not now, sorry, since the past 5 years, long-term contracts with European and Japanese suppliers, and they've also installed a plant to distill lower purity like hydrazine hydrate. This is firstly to bring down their material cost, and secondly to kind of reduce their dependency in China for this specific chemical. They have also developed local Indian suppliers for more than six raw materials in the last 3 years, and currently they're also at a pilot stage for localization of more critical raw materials. So their focus is on diversifying China dependence for key raw materials. Then yeah, so prices as well, if we see of these each chemicals, they are very volatile and they have significantly gone up. And to counter it only, they have been taking these measures, such as the plant to distill lower purity hydrazine, etc. So they are very focused on bringing down their material cost, because this is one of the things that directly affects their margins. Yeah. Another thing is, yeah, so 60-70% of their operating cost itself consists of raw material expenses. Uh, like like this graph at as of FY23, if you look at this graph, it's at 63%. So like rapid changes in like the prices, etc., directly affects them. And 30-35% of their raw material requirements are met through imports, like I said. So one more thing that comes into picture is foreign exchange fluctuation. So this forex risk is also a thing for them. So that's why they are more focused on reducing the dependency, and they are kind of trying to develop locally sourced raw material. Next, I'd like to move on to competition. So here I'd say they're doing pretty well from whatever I could collect from various data sources in sustaining their market position wherever they have faced competition as such. So firstly, I'd like to talk about Latin America, because here they faced very fierce competition from Chinese peers. Here they were making the chemical diflufenicin, which Rishabh talked about. And yeah, they're also increasing capacity currently. But what happened here was, because of competition from Chinese peers, they had to kind of drop their prices to gain market share. But since they got into the market, they have been able to increase their market share from 20% to around 55-60% as of FY22. And yeah, next is Europe. So Europe, the thing is, they have this strong entry barrier advantage, wherein they have they have 358 products which are REACH registered, pre-registered. REACH is basically uh, organization that certifies chemicals in Europe by the EU Union, basically. So they already have significant amount of already registered products. They also have that subsidiary of theirs in Belgium that focuses on marketing for them. And for these licenses and registrations, it takes 6 years at minimum. Least you could do is 3 years, and the maximum it could take is 10 years. So it's very difficult to compete with them here. No matter, even though Punjab is a small company, but here I see that they have a certain advantage. Lastly, I would like to talk about the moats. So first, their relationship with UPL. Here, I would like to make a little correction. I think we had some misunderstanding in the succession plan thing. We mentioned that there is no successor, as in there's no member from the family. But actually, Mr. Shalil Shroff, he is the son of the person that started the company basically. So this Shroff family, if yeah, they have stake in Transpec, then UPL, Punjab, and then two, three other big names in the agrochem space, which is pretty interesting. And from whatever I could find, I noticed that this Mr. Rajnikant Shroff, who is the chairman of UPL, he is related to the person who started Punjab Chemicals. That is the father of Mr. Shalil Shroff, who's the current MD. So yeah, I would definitely like to look into this further. I mean, I tried my best to kind of find out the link or the connection that they have, but this is all I could get. But I wonder if that is one of the reasons why UPL has such a great relationship with this company. But however, it still is a big moat for them because I think twice UPL has kind of bailed them out. Once that was by buying out their industrial chemical plant in Tarapur, and then several offices in Mumbai as well. And again, like we mentioned already, that UPL is in their top three customers. So registrations, all this I've mentioned already. So they have a certain advantage here in Europe, especially because they already have 358 products that are REACH registered and other products that they have licenses for. Next would be their renowned clientele. So I think in this company, their clientele is very important to them because first we saw that CAPEX is 50% or 50-60% funded by their clientele. That is the entire CAPEX. So if you see Heranba or Bharat Rasayan, as such, I read their con calls and annual reports. If they're talking about capex, it's mostly funded through internal accruals or debt, and um, and if there is the customer involved, then it's mostly for a certain registration. But in this case, their entire 50% of their entire capex itself is funded from their customers. This is certainly an advantage, but also can be a key risk if there's some kind of a conflict between them and their customers, because this will result not only in them losing business, but also a certain amount of their capex amount, which the customer is funding, that will also be directly affected. So it could be a significant risk for them. But however, at the same time, this is also their key mode. Next, yes, my bad. So next, I'd like Rishabh to continue with the valuation.
Thank you, Shantanu. So now I will be sharing my screen.
Yeah, one second. Sorry. Yeah.
So this is the valuation done by me. First of all, I say sorry that I have done some mistake regarding it should have been FY24 and FY25, and I was not able to correct that mistake because were in a very tight schedule. So that FY23 I think should be we should consider as the valuation part. Now, regarding the valuation part, you can see that the historical PE of Punjab, the PE I have taken median PE, it is 33, whereas its current PE is now around 13 or something. And if you compare with all its peer, Bharat Rasayan, Heramba, Revis, and Dhanuka, it is quite undervalued. And I have taken three cases here: bull case, base case, and bear case. And suppose I assume that the company's PE will re-rate by say 20. It will become 20. Now, if I take any of the case, like if I take bull case, or if I take bear case, or even if I take that their case, sorry, in all of them, depending on your time horizon, you will make a 71% profit. In all of them, you are going to make a profit. So, as the company has a very company engages in long-term contract with its clientele, and the clientele are quite large. So, there is less chance of them doing default on all their loans on their product. So I think that in all the case at present the company is undervalued, and even if the case is very bad, uh, if the company is earning uh, is growing its top line by 10%, then also you can expect a return of 71% in the next year. So this was the valuation done by me, and with this I conclude our presentation.
Great. Just one question, Rishabh. So I don't consider column G, right?
Yes, sir. Sorry, sir. I did a
Hide
mistake.
it, hide it. Please hide it once.
1 minute,
I
sir.
just want to kind of understand this.
Oh, 1 minute. 1 minute.
Just no,
Yes,
no.
sir. I'm holding.
Go into G and then right click. No, come on. Press Control Z. Go into G and then right click, and then you'll get an option of hide. Unselect it. Uh, right click and then you see hide
Yes,
at
sir.
the second last. Do that.
Yeah.
All right, perfect. So you're expecting that the revenue would grow by 10% and it would
No, sir. I am accepting
or
the revenue will grow by 15%. 10 is the means the most pessimistic assumption.
pessimistic. Okay.
Yeah.
So and your cogs are also growing at proportion, same proportion,
Yes, sir.
right? Cogs and fixed cost and all.
Yeah.
So this is FY25, right? The heading for H.
Yes, it should have been FY25. I like did a mistake, sir.
Yeah, you
There.
can change it now also, no problem. So okay, that is FY25. Okay,
Uh, I'm getting confused actually. So FY22, what is written? That is
that is 23. That should be
that would be
23.
yeah.
So all the years are, I think, one
Yeah, yeah.
displaced
Yes,
by
sir.
one.
In the mistake
No
sheet, it
problem, no
was.
problem. No
Yeah.
problem, no problem. Uh
So what gross margin have you assumed
1 minute, sir.
for FY25? 37%.
Yes, sir.
Okay. What has been the gross margin over the last 6, 7 years? Yeah, that is a reasonable assumption that they should be able to do that much.
Hmm.
yeah,
Okay.
pretty much flat gross margin, right? I think
Yeah.
this quarter after the I mean annual report comes, maybe it might dip a bit. Screener will do that recorrection again,
So
probably.
there was the gross margin FY22.
Yeah. So
Hmm.
your gross margin figures FY18 to 21 are not correct, huh? So those figures have to be corrected. They are much higher gross margins.
Okay,
Uh,
sir. I
40%.
have taken from there, sir.
Yeah, no, you have to verify these numbers.
Okay, sir. Okay,
These
sir.
excuses won't work, Rishabh. If there is
Okay,
an
sir.
error in the sheet, it's your responsibility
Actually,
to.
I didn't check that one. Okay, sir.
Yeah,
So
this
now,
is actually not acceptable. Both you and Shantanu, both of you made this mistake. The gross margins are much higher than that.
okay, sir.
So they're around 37, 40% gross margin. So because you're, see, this again sort of shows the experience of analyzing companies, right? If you're how can a company which is doing 25, 26, 27% gross margin deliver that kind of ROC? ROC
Hmm.
in those years is 30%,
Hmm.
30%, 35%, right? So keep an eye out for these kind of things. And
Okay,
you
sir.
guys had a lot of time to analyze this. I understand Shantanu was busy, but these kind of numerical errors should not be there. Uh,
Yes.
Okay, so what is the EBITDA that you guys are predicting for FY25? Rishabh, you should have a line for EBITDA, you should have a line for gross margin. Uh, that should be there because these are the numbers that we look at, right? The EBITDA percentage, the gross
Yes, sir.
margin
For the
percentage.
next part, sir, I will make a new model, sir. I will incorporate many things like gross margin, EBITDA, and all those things, sir.
Oh, why not this time?
Sir, this time, sir, I think they would actually after your valuation series, I didn't watch that video, and when I started watching that this part, I thought that many things like I had lots of problem doing it, like this one, sir, that it showed FY22, but here we had in the screener FY23. but at that time it was late to make all those changes. I wanted to discuss with Shantanu, but Shantanu tomorrow he was not available. He was in a Viva, so I was
Right,
also
right,
not
right.
able to discuss with him.
It's okay. It's okay. It's okay. We
Yeah.
understand you couldn't do. That's okay. Now,
It is my mistake.
please.
I should have started quite earlier. That I acknowledge. It is
So,
my
Rishabh,
mistake.
what is the EBITDA percentage for FY25? I calculated it's coming at around 29% for FY25.
So FY 25, 29%.
Calculate the EBITDA and as per your model for FY25, no?
Yes, sir. The revenue minus COGS is GA. Yes, sir. Mm, is divided by what I'm doing. Earning before interest, tax, and depreciation. This minus this is 348, and the EBITDA margin was this. Uh, so 28%.
Yeah. Now tell me, 28% has Punjab done any time in their history?
So
And this
EBITDA.
is, yeah, this is your bear case, mind you. This is not your bull case.
No, sir.
Shantanu, what is the maximum EBITDA they've ever done in the last 10 years?
I think 17 was the maximum.
Yeah, I can see 15. I don't know where you're seeing 17. On screener,
July
it shows
July 21. It was
quarterly.
17
I'm seeing
quarterly.
yearly. Yearly 15% in 2022 is the highest EBITDA I can see. So, Rishabh, there are big problems with your model.
Okay, sir.
The model is not correct. And tell me something, haven't they guided for 1500 crore revenue for FY25?
Yes, sir. No, sir. They have not mentioned about the year, but they are saying that their next target is 1500 crore.
Are you sure they have not mentioned a year?
Sir, as far as I read, I have just found out about the number, not the year.
Okay, all right.
One more
Cool.
doubt.
Gaurav, over to you. Yeah,
Uh,
Shantanu.
Sorry. The EBITDA margins, could that be wrong as well? Because the gross margin calculation went wrong. Uh,
Guys, I don't
during
know what happened in the sheet with
Right.
you guys. You need to check the sheet, but I'm just looking at numbers from screener and just telling you from there.
Okay, no, we'll check again.
Yeah,
Okay, sir.
is this
Yes,
the
sir.
sheet that we have, the normal
Yeah,
ratio sheet?
yeah.
Yes.
Actually, the issue was Screener updated their data from they had included FY23 as well. So I
Okay.
think while doing the calculations, we took it from FY13, but I think it should start from FY14 till FY23. But I'll just check again and get back to you because I'm not too sure.
Yeah, then in that case, our sheet needs to be updated maybe. I don't know what the issue is, Shantanu. So if you can revert by tomorrow
Yeah.
what has happened in the
Yes.
sheet, then we can do the necessary corrections. Yeah.
Yes. Sure.
Okay, Gaurav, over to you.
I have like couple of questions. I wrote it down over here. First one was, what was the reason for? I mean, since you guys read about Dhanuka and Heremba, um, what was the reason for such high net fixed asset turnover? In any special thing that happened? Just curious because you were comparing peers.
Gaurav, Dhanuka, I can tell you, Dhanuka
Hmm.
doesn't own assets. It is just a sort of
Okay.
like very low asset kind of turnover kind of company. So that's why the high turnover. Ranba, I'm not sure.
Acha. Nirvan, do you think when we are doing this peer comparison, we at least go like say one or two sentence, what are their products or how do they operate in a very brief when we are when they are comparing?
I think the
Because
presentation is already too long, Gaurav.
too long. Yeah, we have to cut short on many parts, but that I think, I mean, comparison between it might become apple to oranges sort of.
In
But
this
we can
case, I
discuss
think
this. We
the
can discuss this later. It's
yeah,
okay.
I think this case the selected companies were sort of okay,
Okay.
except for Dhanuka, I think, because Dhanuka doesn't manufacture much. My limited understanding.
Yeah.
So there, some of their ratios will be different.
Right. So another thing, Shantanu, Rishabh, what is not clear to me, I mean, you guys were seeing a lot of things about, capex happening here and there
Mhm.
and revenues coming. But what I also, I couldn't see it. And now I don't, I couldn't write it down while you were saying, and I don't have it, have a map in my head. So if you could maybe give that as a supplementary thing.
Yeah, we
So
actually have a document. We'll share that one.
sure, sure, sure. Just add it in the slide, make it into a tabular format. I mean, if, for
Yeah.
example, these are the areas where their plants are, these are the capex that is happening. This area has brownfield scope, this area doesn't have brownfield scope.
Okay.
Current work in progress over here, and from there we kind of get a number, right?
Yes.
What is the this thing. And I think also what Nirvan said regarding this guidance, I think you should definitely check it out, because there are
Definitely.
very serious guys looking at this company, so it won't be off.
Yes.
You check out what is for FY25, please.
Yes.
um, Another thing is, I think I'm a bit curious, how is the company spending its profits? My personal feeling is this company is a bit, what do you call, they are not minority friendly. I feel so. Maybe Nirvan, you might have a point of view over here. What do you think?
Why would you say that? I don't have a view, but interested to hear why you think so.
Uh, uh, Number one is, wait, let me. I wrote it down. Couple of things. Uh, One, there. I mean, they have their family members over there. I mean, that's not a big point, but uh, there's one thing about. Wait, I was scribbling down.
See, I think they one good thing is they start like they mentioned also in the PPTs that they
Hmm,
started paying dividends after
hmm,
the CRAMS model started giving. So till 2017, zero dividend. From 2018, they started paying a good dividend, and they've increasingly, paid higher and higher absolute value of dividend. So that I consider to be minority friendly. Okay,
right,
returning cash, right?
right.
See, they don't generate too much FCF after
Hmm,
paying dividends. So I haven't seen anything that is telling me that they are hoarding cash. Look at their cash balance. Cash balance is also not very high on the balance sheet,
hmm, hmm,
right? So,
hmm,
see, if you look at Sharda Motors, they are carrying some 400 crores of cash on the balance sheet without returning it, without acquiring anything. That I would say is sort of, suspect governance. Here they are doing capex also. Punjab has done capex recently. They are growing fast. Okay. They are giving a dividend. So nothing jumps out at me as saying minority unfriendly on the face of it.
right. Right, right. No, one thing that triggered me, I remember, what triggered me was the Rishabh's forensic analysis, where I
Yeah,
mean
rent
they were
payment.
kind of taking out, siphoning out a lot of, not siphoning, probably they're taking
Yeah.
out a lot of money
So
for rent and all of those things.
correct. So a lot of money. I think the only one point which really rankled with me was the rent. So my
Hmm,
question actually to the team was, and I'll send all these questions. See, generally when a promoter-owned company like this, where a lot of family members are running the show, there can be multiple ways of paying the promoters. One, they could show it as rent, or they could take a larger salary. Okay. So one
hmm,
exercise you guys can do is try to see if there what is the total salary that all the family members are taking, add the rent to it and divide it by the profit. If it is higher than 13%, 14%, then yes, that they are paying themselves much more. See, what is the guideline? I think 13% is the guideline. I don't exactly remember. That's
Yeah.
SEBI, right, Shantanu?
13%.
13%. So rent plus remuneration, if that is exceeding 13%, then yes, the rent is excessive. If suppose they're compensating the rent by taking very low salaries, then I am more or less fine. This is how my thinking has evolved over time. If we look
yeah,
for MNC level governance in these kind of companies, nahi milega yaar. Then we'll start rejecting companies for a lot of reasons like this.
yeah. I agree on this part. Right.
So I have 4 or 5 questions, but it's already 7:30. So how do we do this? Do we do it tomorrow or?
Let's
Uh,
have a valuation session. I mean, we will have a valuation session from them, right? I'm curious about the
yeah,
valuation of this company.
valuation plus like I have multiple questions to them. So
Hmm,
shall I just send the note today and we'll discuss the questions tomorrow?
sure,
Uh,
Nirvan.
I mean, I'm not expecting answers by tomorrow, but I'll make my thought process clear on the questions tomorrow, and then maybe this team and the IPL team in 1 or 2 days can do that
Can
and
kind
move,
of do it.
yeah, move around to the next company.
Yeah. So I wrote my questions in the chat window. You can maybe copy them. I'm
Yeah,
curious because in the presentation you guys never said about what is plaguing the business right now. I mean, the share price is falling and it's getting derated. What are the reasons for that? That's probably of interest, because we need to understand why is it happening, right?
yeah. From what
So
I
those
understand, it's basically inventory destocking.
inventory, no? Yeah.
Yeah. So, for example, I heard or I understood that UPL last quarter did not buy any Metametron at all
Hmm.
from them because they were already carrying large inventories of Metametron. So that's what I heard happened. One very good angle that this presentation gave me, which I did not have before, is what Shantanu mentioned regarding the connection of all the Shroff guys across companies. And the biggest, insight to me, I also used to think कि UPL और इसका इतना relationship अच्छा क्यों है? I think
Uh,
you guys helped answer that question. So I did not know that Shroffs were in charge of UPL as well as this company as well as Transpec, etc. So that is definitely very, very interesting because if this company is depending on that family relationship of UPL to sell maximum products to UPL, then I will give them a lower multiple than just their ROC numbers would command, because if that relationship goes long, that means there is the moat is the relationship, right? And okay, relationship may go sour sometime. So I would prefer a capability moat rather than a relationship moat. Market may view it differently. I would probably lower the multiple a little bit if that is the main reason that UPL loves Punjab so much. And like rightly said,
hello. Uh, can anybody hear me?
Yeah.
Okay, Nirvan.
build out
We can't hear you, Nirvan.
Punjab 2 3 times in the past.
Hey, Nirvan, we couldn't hear you for some time, I guess. Was it the same case with others?
Yeah. I think so. I lost
Acha,
my connection, I guess. Am
acha.
I audible now?
Okay, okay. Yeah, but your voice is breaking, cracking a lot.
Okay. Carry on. Then I was anyway finishing up that point only. Carry on.
Right. So another question from Astha, maybe Shantanu, you can take that as well.
Oh, it's in the
Uh,
chat.
it's in the chat. Just
Oh,
copy it, and maybe in the session where we have another
yeah.
round of discussion, you take it up as well. For me, I want to understand what is the issue. I mean, issue that already we know, inventory.
Yeah.
I would like to know the utilization of the company in general. If they give anything, if they don't, we can't do much. And you said that they were doing a lot of things in India. I mean, R&D and all.
Hmm.
Do you see them improving their gross margin? I mean, do you get any hint of that? Like
Okay. Yeah.
in any way they are improving their gross margin? But that's mostly it. Yeah. Okay.
Yes.
Cool. Others, any questions? Anything, feedback, anything? And I think last feedback from my side is Rishabh, Shantanu, next time you present, just compress it a little bit so that we can have good time for question answer. Else it just went too long.
Yeah.
Yeah.
Sorry, we'll
No
compress it.
problem. No problem. All right. If there are no other questions, then we can close for today. Hello.
No other question from my side.
Awesome. Okay, cool then. Let's close for today. I think thank you so much, Antanu and Rishabh, again for the good presentation. I hope to see a good. I mean, that valuation,
Yeah.
what you do. I mean, yeah, that would be interesting for me.
Yes, we'll
I
fix that.
already have a position in that company, so I'm curious
Oh,
whether I should. I should. What should I do with it? Yeah,
yes.
I think Nirvan would also have some tiny tracking, maybe.
Yeah. I have a 2% position, but
Ah,
I really haven't worked on this company. I have just taken a 2% position because I feel this is the lower end of the cycle. They are guiding very strongly. Plus, Harsh, who is an expert on AgChem, has a good view about this company. So I was actually, I'm hoping that you guys will make the case for me whether I should increase the allocation, keep the allocation, or sell my allocation because. I am not sure. I haven't done the work to be honest. I generally take up 1 2% positions when my gut tells me that something is going in the right direction, but sometimes I'm proven wrong later. So, yeah. So from your valuation, guys, that is what That's the
Yeah.
selfish motive that I have and Gaurav also has. And if
yeah.
any of you want to take up a position, you will also have a selfish position that okay, 1500 guidance देना तो बहुत easy है. Are they going to achieve it? When are they going to achieve it? what is a fair multiple to give to this business? Have they commanded that multiple ever in the past? Yeah, these kind of things is what I would love to hear. Yeah,
Their
sorry.
their liquidity is getting very poor. I mean, sometimes you'll see very few quantities getting traded in the entire day.
Punjab Chemicals, you mean stock liquidity? Okay. Okay.
Very poor. So if anybody is selling, I mean, one, two chota transaction takes up the stock so high, and
Yeah.
the bid ask spread is too high. I mean, if I buy
Mhm.
it in market, it can, if I put it at, say, whatever price it is. I mean, I don't know. Let me remember. 783 though. So if I put it at market, it would go up till 790, and
Wow,
then it'll fall down. Yeah, this is so stupid.
that's
Uh,
crazy.
I
That's
I did
also
that.
probably this a sign of the sector completely being out of favor.
Yes, yes. Either nobody is selling, or yeah,
Yeah,
there's just very little amount of trading that is happening over here.
right, right.
Cool. But yeah, I think
Okay, okay, guys, I'll send you the notes. We
Yeah.
can discuss tomorrow.
right.
Thank you
Thank
so
you.
much for the presentation. Take care,
Thank
Bye
guys.
bye.
you, everyone.
Bye.
Bye
Bye.
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 Good night.
Bye. Good night.
Thank you, sir.
Thank you.